What if the biggest investment boom in the world right now isn't actually driven by real profits, but by something that feels like wealth creation, looks like growth, and behaves like a bull market, but quietly hides a distortion underneath? That's the warning from Michael Burry, the investor famous for predicting the 2008 housing crash. And his word for what he believes is happening in parts of the AI trade is simple, unsettling, and controversial: the Bezzle, a term that suggests the market may not be creating real value at the pace it appears to be, but instead building a temporary illusion of wealth that eventually gets exposed. So what does it actually mean, and why is it suddenly showing up in conversations about AI stocks? Nvidia, data centers, and the entire tech rally? Let's break it down. Where the word Bezzle comes from, the term originally comes from economist John Kenneth Galbraith, who used Bezzle to describe something very specific in financial behavior: a hidden period of illusion where both sides of a transaction feel wealthier than they actually are. In his framing, a fraud exists, but it has not yet been discovered. So both the perpetrator and the victim feel financial improvement, until reality eventually corrects it. The key idea is this: the wealth feels real until it suddenly isn't. There is no immediate alarm, no obvious collapse, just a growing disconnect between what people believe is true and what is actually sustainable. And that delayed realization is what makes the Bezzle so dangerous. Because by the time it becomes visible, it's already too late to ignore. Why he links it to AI when Burry refers to the Bezzle in the context of AI, he is pointing to a specific dynamic happening in markets. A massive wave of capital investment into AI infrastructure, including data centers, semiconductor companies, cloud computing expansion GPU, demand surges, large-scale AI model training costs. On the surface, this looks like a technological revolution, and in many ways, it is. But Burry's argument focuses on a different angle. Are current valuations and spending levels justified by current earnings? Or are they being driven by future expectations, narrative momentum, fear of missing out, and speculative capital rotation? The mechanics of the Bezzle in markets, to understand it clearly, think of it like a layered process. 1. Innovation phase A, real technological breakthrough emerges. 2. Capital rush, investors flood into related companies expecting massive future returns. 3. Expectation inflation, revenue projections and valuations expand rapidly. 4. Forward pricing, markets begin valuing companies as if future profits are already certain. 5. Disconnect phase, actual earnings growth starts lagging behind expectations. 6. Reality adjustment, the market eventually recalibrates valuations back toward fundamentals. The Bezzle exists in the middle stages when everything feels correct, but the math hasn't caught up yet. And crucially, it doesn't feel like a bubble while it's happening. It feels like progress. Why this phase is hard to see in real time, one of the most important parts of Burry's warning is that the Bezzle is not obvious while you're inside it. That's because prices are rising, the news is positive, companies are growing, investment is accelerating, and innovation is real. So nothing looks broken. In fact, everything looks like success. But underneath that success, a subtle issue can form. Future expectations become too large compared to near-term earnings reality. Why AI specifically triggers this debate? AI is uniquely powerful as a narrative driver because it is genuinely transformative. It affects almost every industry. It attracts both retail and institutional capital, and it has extremely large long-term potential. But that combination also creates a risk. When something is truly revolutionary, markets tend to assume faster adoption, faster monetization, faster profit scaling, and sometimes those assumptions run ahead of what is technically or economically realistic in the short term. So, the concern is not about AI itself, historical pattern context. This type of market behavior is not new. In fact, it has appeared repeatedly across different eras, industries, and asset classes whenever a genuinely transformative idea collides with an influx of aggressive capital and forward-looking expectations. The pattern tends to follow a familiar structure. A real innovation emerges, capital rushes in early, and markets begin pricing not just what exists today, but what could exist at scale in the future. As that optimism compounds, valuations start to detach from the speed at which real-world earnings can actually materialize. You can see this clearly in several major historical cycles. During the dot-com boom, the internet was undeniably a real technological revolution. The infrastructure built out fiber optics, web platforms, connectivity networks was transformative. But the market prematurely assumed rapid monetization across almost every internet company, regardless of whether their business models were proven. Companies were often valued on traffic, clicks, or potential reach rather than sustainable profits. The innovation was real, but pricing moved ahead of economic reality. What would confirm or disprove this view from a market perspective? The debate often comes down to if the bullish AI thesis is correct, revenue growth accelerates into valuations. Infrastructure spending leads to strong cash flow returns. Profit margins expand as adoption scales. If Bezzle concern is correct, spending stays high, but ROI lags. Growth expectations slow relative to valuations. Market multiple compression occurs even if AI usage grows. In both cases, AI can still succeed. The difference is how efficiently capital gets returned to investors. Final thoughts: the Bezzle is not just a dramatic phrase. It's a warning framework about how markets behave when stories run faster than earnings, expectations run ahead of execution, and capital flows faster than real-world returns can justify. In Michael Burry's view, parts of the AI trade may be in a phase where that imbalance is growing. If you found this breakdown valuable, make sure to like, subscribe, and turn on notifications for more deep dive market explanations like this. And drop a comment below. Do you think AI is still in early growth or already entering the Bezzle phase?